You're listening to The Moose and the Loose, your 10 minutes action-packed financial podcast with your host, Mike Yahoo. Hey, what's up, Market Moose? Mike from The Moose on the Loose. I hope you are doing well on this Wednesday. As I told you, a little bit late because I wanted to review National Bank on top of Scotia Bank and BMO quarterly earnings. As you know, next week, next Thursday, first Thursday of March, I will have a complete video on the YouTube channel reviewing the Big Six, telling you everything that you need to know about the quarterly earnings. But since Royal Bank, National TD Bank, and CIBC decided to report it tomorrow, I cannot pull out this video as quick as I hoped. So we're going to give you a little insight of what happened this quarter for the first three banks. One thing that seems like more and more obvious, but a lot of investors tend to forget is banks are not created equal. It's not because they're Canadian banks that they're doing the same thing and that they have the exact same business model. So yes, they are all operating in Canada with personal and commercial, with wealth management. It's all the same. But then they all decided to take different path to growth and change their business model a little bit. And when you're thinking, oh, I'm buying a bank, I'm buying a Canadian bank, so I don't have to worry about anything. Well, I'm sorry to tell you this, but you're wrong. They're all very different today. And the earnings that we're going to talk about today are also quite different. And this is what is really interesting, is to see how those different decisions over the past 15 years pretty much since the financial crisis of 2008. After that, all banks decided to go in different paths. They kind of tented their results. So let's get started now with Scotiabank, and you'll see what I'm talking about. So Scotiabank actually did a pretty good quarter. So revenue up 11%, adjusted EPS up 4%. So everything is in the positive, which was really good when you look at it first thing. And then you start digging and then you realize that a good part of the business is earning. Actually, Canadian banking, so their Canadian operation, the net income was down 6% because provision for credit losses, were higher. PCLs are going to be the big talk for a while. We have tariffs coming up, so banks are going to brace for the impact for sure. We were already unsure about the smooth landing with higher interest rate and higher inflation over the past few years. So already the banks are on the edge for that, but they keep on increasing their PCL. So that hurt Canadian banking by 6%. And then we had international banking that was also down by 9% for the very same reason. So lower interest income plus higher PCLs, lower income international banking. I mean, they've been telling us that they were the most international bank for the past 15 years. And they failed reporting constant growth there. And another example of that unfortunate failure is that they're selling their banking activities in Colombia, Costa Rica, and Panama. Actually, when you look at the GAAP EPS, so the non-adjusted, the one that are using all the numbers, well, they were down mostly because they had to record an impairment charge of 1.16 billion related to the sale of those banking operation. So overall, that was not that great. So how in the world they ended up with a positive earnings per share this time? Well, of course, adjusted. So you're taking a $1 billion in impairment charge off of their weight, and also capital market that did very well. So this one, the net income was up 33%. Actually, we ended a year in 2024 that was great on the stock market. And keep in mind, the banks, their first quarter starts on November 1st. So you have November, December, and then January. So those were also good months on the stock market. So capital markets was up 33%. We'll see that other banks will be the same. Wealth management also was up 23% on higher fees. So of course, if you have a market that goes up, that means that your assets under management are also going up, and then boom, you charge a revenue on that. So you are making money. So anyways, so overall, on surface, it looked good. If you dig a little bit deeper, disappointing. So it's not doing that great for Scotiabank. And I'm not surprised this is the bank that is lagging behind the others, right? Moving on to BMO. BMO had a pretty good quarter. Good reaction on the market yesterday as well. The stock was up. Revenue up 21%. Earnings per share up 19%. So like strong double-digit growth for BMO last quarter. Kind of ironic because last year we talked about the problem that their PCLs were out of control, and actually, it's still the case. So provision for credit losses and impaired loans was of 859 million, and it was an increase of 386. So it's going up, and the total PCL across the board went from 600 million last year to a billion this year. So that's a lot. It's still not really under control, and it has also weighted on their personal and commercial performance. So in Canada, PNC net income was down 3%, even though revenue was up 10%. So PCLs hurt again. In the US side, was only up by 2%, mostly slowed down also by higher CPLs. So similar to Scotiabank, the core business, personal and commercial loans, not doing that well. Wealth management saved the day with net income up by 53%. So we all know BMO is really strong when it comes down to the market. They have like their ETF. They were like one of the first bank going for private banking with the acquisition of Harris Bank like a while ago in Chicago. So they have been a pioneer in Canada for this. And once again, that department is doing well. Capital markets, that is also another big department for BMO, was up 49%. So while the core regular business not doing that well, the regular like the growth segment, wealth management, capital market, did incredibly well. So that's pretty much good news overall. The market liked it. It's time for BMO to report some good quarters, but I will still have an eye on the PCLs. Moving now to National Bank, the last one of the bunch this morning reported. I'm really looking forward to see how the market will react, but revenue was up 17.5%, and adjusted earnings per share was up 13%. So very strong quarter for National Bank. Ironically, though, the personal and commercial net income was not the good part. It was down 14% on higher PCL. The PCL actually more than doubled, going from 120 million in Q1 24 to 254 million this quarter. So definitely not good news. Again, we can see that banks are preparing for a big impact on the economy with the tariff, with the 2-3 years of inflation and higher interest rates. So maybe cutting down the interest rate was not soon enough. We'll see how it goes. But all banks are telling us the same message. Good news, though, is all the other segment did very, very well. So wealth management up 23% on higher fee-based revenue. Financial market up 35% on very strong revenue growth of 40%. And then their US and international expansion with Credigy and ABA Bank also did incredibly well. So that net income for that department was up 22%. Another big news for this one is that Canadian Western Bank acquisition has been completed faster than expected. So when they announced that big news, they expected to close the deal around the end of 25. And then here we go in February, it's already done. So if you are a Canadian Western Bank shareholder, well, you're not anymore, and you got some National Bank shares instead. So overall, good quarter for them. Same story about the key business in Canada, but fortunately for them, all the other segment have greatly improved the overall quarter. Super happy about the Canadian Western Bank acquisition. It's a great door opening to Western Canada. This bank has also about 37 billion in commercial loans, but they did not have wealth management department to serve those clients. So the thing is, when you have like a lot of commercial loans, that means that you have a lot of business owners, like big business owners. And when those business owners, they sell their businesses, well, they come to the bank with a big check. So it's the right time to build a good relationship before they do this, and that they know about your private banking services and so on. So I'm guessing that National Bank is going to run after this very quickly to ensure that they can grow the business on the western part of Canada. So yeah, that was a quick summary, my dear Moose. 3 banks. Overall, doing well. Again, Scotiabank is getting hurt by their international exposure. Now they're cutting down on this, so it's going to be interesting to see how it's developed. BMO is going to die by the sword or live by the sword with their exposure to capital markets and wealth management. This time it did well. And then National Bank having like so much growth vectors going on, even if they had a poor quarter on the personal commercial side, the rest of it was really, really strong. So I'm really looking forward to review the other 3 and see what will be the big story developing this quarter for banks. You're going to get there next week on my YouTube channel at The Dividend Guy. And until tomorrow, don't forget to stay invested.
Hey, welcome to the disclaimer. If you're listening to The Moose and the Loose, you cannot really expect me to give you buy or sell recommendation or financial advice, right? You're here for fun, you're here for information and some entertainment. But I am not your financial advisor, I am not your broker, so therefore I'm not liable if you're losing money after listening to the podcast. If you're looking for some advice, go see a professional. If not, you can enjoy the show and do your due diligence after it.